honored to have Janus Henderson, to have Andrew here, who's an investment specialist, talk about having some investing in healthcare and life sciences innovation. And we also have Hugh, who's the Chief Investment Advisory Officer from Endowus as well. Let's try this mic to see this. Okay, I think this is better. Thank you. So I'm going to give a little introduction of Endowus before I pass it to Hugh and Andrew. So Endowus is a digital wealth management platform in Hong Kong and Singapore. We started in Singapore in 2017, and we soft launched in Hong Kong last year, and we officially launched in Hong Kong earlier this year with our investment summit in April. So in Singapore, we're actually the first digital platform where you can invest your pension money. So that's Singapore's version of Hong Kong's MPF, as well as your private wealth, so your cash assets. You can invest everything from money market funds to long-only equity credit funds to alternatives like hedge funds and PE funds. So since we're talking about healthcare today, I thought I would start off with a healthcare analogy to describe our business model. So imagine you went to see two doctors. So Dr. A prescribed you the red pill. Consultation is free. What a great deal, right? But what you don't know is that the pharma company that sold him this red pill actually pays the doctor. So the second doctor prescribes you a blue pill. Unfortunately, you have to pay a consultation fee. But behind the scenes, he doesn't receive any kickbacks from any pharma companies, so he sells you what he thinks is actually going to solve your medical problems. Which doctor would you rather go to? Unfortunately, most of the financial services industry in Asia is on the left side, the red pill. How they make money is kickbacks from product providers like different asset management firms. So it's hard to know if your bank or your whatever platform you invest in is truly aligned with your best interests. But the model that we do is on the right side, the blue model. We're fee-only, independent, conflict-free. And what that means is that we're only paid by our clients on the assets that we manage for them. We're not paid by any product providers, so that we can always remain independent, always aligned to our clients' best interests. So our mission as a company is really to empower all of us to invest better, to live better, through evidence-based advice, institutional access, and low fair fees. If you look at the logos at the bottom, these are some of our shareholders, like BBS, Citi, Lightspeed Ventures, etc. And on the left logo is actually Endowus employees. We're the largest shareholder in our company. So we take a evidence-based, holistic approach to asset allocation. We're not a trading platform. We're not about speculation. So when we talk to clients, we always ask them, why are you investing? What are your goals? Is it for a rainy day fund? Is it to save up to buy a house? Is it for retirement? The why, we think, is very, very important because that helps you decide what's your risk tolerance? What are the right products to be in? So we don't start off with, we promise you we can beat the markets, because we think that's not the right approach to investing. Because at the end of the day, whether you beat the S&P 500 index or not doesn't impact your life. It's whether you can meet your life goals, and whether you can retire, for example, the way that you want to. So we can serve your interests, everything from your immediate cash flow needs, any of your sort of purchases you may want to make in the midterm, as well as your long-term sort of retirement goals, etc. And it's a sum of all these different goals and portfolios for each goal that make up your overall asset allocation. So we work with the top global fund managers at Endowus, and we have an investment team that's run by Hugh that selects which of these managers to work with and which of their strategies to onboard. So we're not a fund supermarket. We're not going to have 2,000 funds on the platform. We really believe that our value add is in curating these products to find what's best for our clients. So we work with top managers like Janus Henderson to offer their products to our clients at a low fee. So everything from money market, fixed income, equities, private markets, etc. And these are only some of the managers that are currently on our platform. We talk a lot about fees. So if you look at the chart on the bottom, A 1% difference in 30 years isn't a 30% difference in your returns. It's actually a 245% difference in your returns. And we always talk about the power of compounding, but the power of compounding also applies to the fees that you pay. So we want to ensure that we charge a low and fair fee to all our clients. So our fee of 0.1 to 0.6% is charged as a percentage of your AUM with us. So we're only incentivized to grow your assets over time. Everything on our platform can be done in-app, so it's very, very simple. You can do your investments, your redemptions, etc. You can see your portfolio on a daily basis, on its performance, what the performance attribution is, what your asset allocation is. But we also have a team of client advisors that you can speak to at any time, because we believe that wealth management, wealth is a very personal thing, right? It can never be a completely digital experience, so whenever you need help, we make sure that there's always a human there to advise you on your investments. We cover a very wide range of clients, so everyone from individuals to professional investors, to family offices, to charities, foundations, as well as institutional clients. And the reason why we're called Endowus, and we get this question a lot, is that we're about endowment investing for all of us. So for those of you who are familiar with, say, the Yale Endowment Fund, right? We believe that everyone should invest like that, with a diverse asset allocation, investing in different asset classes over the long term. And with that, I'm going to pass it to Hugh and Andrew. We have a Slido today, so you can go to slido.com and put in 529.
Okay. Hi everyone, this is Stephanie from Janus Henderson. I'm a sales director in the team in Hong Kong. So before we start the main presentation today, can I bother you to take out your phone right now, scan the QR code here, and do a little quiz with me. We're on the topic of healthcare. We want to gauge what topic that will interest you the most. So Andrew will formulate his speech accordingly. It's a very simple quiz with just 3 questions. So let's get started, I guess. Yeah. First question. So whenever there's a new drug coming, or a company is developing a new drug, what do you think is the percentage of drugs entering human clinical trials that will eventually make it to the end market and you can actually buy this new drug? So you can press the answer that you think is right, and then press submit. We'll get live results here on the screen after you submit it. So don't worry if you have not scanned the QR code just now, you can do it now as well.
Cannot.
No?
No, cannot actually press them.
Okay. Technical issues always with us. Yep, let me try again with my phone to activate the test. Is it okay now?
Yes, no.
Great, I'll use my phone. Yeah. Let's see. Yeah, the numbers are moving. So, I'm actually very impressed. We are talking to somebody very sophisticated today. 10% is actually the right answer. So, we'll hear more from Andrew later how this little amount of drugs actually made it to the end market eventually can be turned into investment opportunities. So next question. Very simple. What would you like to learn more about today? Is it the science behind the health treatments? Is it the fundamentals and valuations across different subsectors? Is it M&A and IPO activities, or even AI in healthcare? Because there are a lot of conversations on AI these days. Right, so most of you, a lot of you want to hear from, oh wow, that's a tie, okay. So both fundamentals about different subsectors and how active managers like ourselves can really generate alpha for you versus the passive side of the world. Okay, final question. This is an interesting one. I think healthcare is a very relatable topic, and a lot of these breakthroughs, actually, we've experienced it in real life as well. be it cancer, be it Alzheimer's in the elderly, or even gene therapy, because I believe there is very little treatment to genetic problems. Right, so Andrew, you heard the crowd. They all want to learn more about new cancer treatments. Right, so that's the end of the quiz. Thank you all for participating. Now, may I pass the time to Andrew Cox, our Senior Equities Specialist, who will give a speech on how do we see healthcare in this sector today and how we turn them into investment opportunities.
Great. Good evening, everyone. Fantastic to be here. Particularly at the event with Endowus, a very exciting new platform. I myself just signed up as a client last week, so very interested to kind of see how it all evolves. I think my microphone's. Do I actually need a microphone, or am I vocal enough? I think it's a bit easier to not hold a microphone. They're a bit heavy, so we don't need a microphone. We're good. So it's fun to be here to talk about a specific sector. You go to these events and they talk about the economy, they talk about interest rates and where they're going to go and when they're going to get cut. And sure, lots of people have views, but does that really make a difference? Yes, it may from a short-term perspective, but when there's so much noise in the markets, it's sometimes better to kind of say, what do I really believe in? And we understand why technology is very popular. We all use technology, it changes the way we do things. But hang about, healthcare I think is more important to all of us in terms of how we live our lives, in terms of the prospects for getting old and being healthier and living longer. So it's a key area that's very important to us, and we also think it's a great area for our portfolios. So I want to kind of start off with why healthcare. Why should I have a healthcare allocation in my overall investment portfolio that's going to preserve my wealth and grow my wealth as I get older? So I want to talk a little bit about some of the key tenets that we see from this sector. I want to start with the progress. Just think about your own experiences of going to the dentist, going to the optician, or your parents or your grandparents in terms of the treatments, the diagnostics they get. As we get older, we all have more tests, we have more treatments. Unfortunately, we're often less well. But it's wonderful to see that there are much better outcomes available in terms of the types of treatment. And this is what's translated in the biotech and in the healthcare industry as well, in terms of the number of new drugs that get approved each year, the innovation that we're getting. We've actually seen a doubling of new drugs approved in the past few years compared to 10, 15, 20 years ago. And last year, 2023, was actually a record year in terms of the new approvals that came to the market. And what do those new approvals represent? They're new revenue streams, they're new drugs that are being marketed and distributed globally. So for the investors behind them, there's a real opportunity of making money. And we've seen a 70-fold increase in so-called blockbuster drugs. These are these giant category killer drugs for diabetes, cancer, heart disease. And obviously the revenues from those are extremely strong, and we see very attractive long-term returns. That's why Eli Lilly, Novo Nordisk are stocks that are being kind of talked about as the next Magnificent Seven players, because the size of the obesity market is absolutely huge, and the penetration potential from the GLP-1s is really set to take off. And this innovation, it's really just getting going. We're seeing a record number last year, but this year is also going to probably be a record year. And that's because scientific discovery is getting much better, much faster. Since they kind of cracked the human DNA 20 years ago, scientists have now been working with it, figuring out how defects in genetics, so for gene therapy, can help treat diseases, cure diseases. The speed of innovation was forefront during the COVID pandemic in terms of how long it took for a vaccine to be delivered. So that innovation is kind of really getting going. And the great news is there's lots of opportunities that still have unmet medical needs, or areas where the treatments still have horrible side effects or aren't quite as effective. So this innovation is great news for patients, but it's also really good news for investors who can get behind these next blockbuster drugs and the ones that will deliver. So I want to spend a lot of time talking about innovation, the kind of thrust of the presentation about innovation, but the other key aspect is demand. Now you hear about ageing populations as being a challenge for the world. You hear about climate change, you hear about inequality of wealth. But actually ageing population is one that's great news for the healthcare industry. Again, think about your parents or your grandparents and how much they spend on on treatments, or their insurance companies spend on treatments, how many more times they go to hospitals, how many more pills they take. My father, he turned 99 this year. He flew from the UK to Singapore to spend his birthday with me. It was wonderful. We went around, showed him the sights. Everywhere we went now, I was pushing him in his wheelchair, carrying a bag full of medicines. And obviously those medicines are great for him because it gives us better quality of life. That's what we want for our family and for ourselves. But it also represents the revenues that are being generated for the pharmaceutical, for the biotech companies. So this demand is good. Aging population is a positive trend. We're expecting people over 65 to double in the next 20 or 30 years. And those people spend typically 3 times as much on healthcare as everyone else. So a strong backdrop for all this innovation with strong demand coming through. And what does this lead to? It leads to healthcare delivering strong returns. Over the last 20 years or so, healthcare has been an outperformer versus the global equity markets. That's because it's full of innovation, it's full of growth. It has actually lagged over the past 12 to 18 months. People have been focused on tech and generative AI, and we'll talk about that later on. But that's one of the exciting reasons that we think healthcare is set up very nicely this year. It's also the view shared by a lot of CIOs at the big private banks and encouraging clients to look at these trends and say, well, actually healthcare, like technology, has this innovation that can kind of help your returns long term. But the other exciting attribute we find for healthcare is it can be very defensive. You remember 2022, that horrible time when you looked at your portfolios and down, equities, fixed income, all performed pretty badly? Well, actually healthcare was a real outperformer that year. And that's because it's got very nice defensive characteristics in terms of resilient income, strong balance sheets. And again, we'll go into a little bit more detail through the presentation. With so many people sitting on cash, record amounts invested in money market funds right now, we think healthcare is an interesting way to kind of edge into the market in a sector that's lagged, but it's got some really nice demand and growth fundamentals through the innovation. So talking a little bit about this innovation in more detail, I've touched on genetics, gene-based medicine. In 2003, they kind of mapped out the DNA for the first time. It took billions of dollars and 13 years to really map it out. Over the past 20 years, scientists are becoming much more effective at kind of breaking down. Technology has helped the diagnostics, the way of looking at DNA, speeding up the process much more, looking at those genetic mutations and saying, okay, how does it lead to certain health conditions and how it can be treated? There's over 7,000 genetic diseases that are linked to genetic makeup, 95% of which don't actually have treatment. But finally now, after nearly 20 years, we're seeing a real surge coming through in gene-based therapies. We've had the first gene therapy for haemophilia, the blood clotting disease, Duchenne muscular dystrophy, a horrible disease that affects children. We're seeing progress in this area, and we're very excited by the biotech industry and further treatments that are going through clinical trials that we think will really offer some good news for many patients. The other area is diagnostics. We all know that it's much better to spot cancers earlier. If we can diagnose diseases earlier, we can have better survival rates, better treatment options, and that's a real opportunity coming through from technology. So the industry is really embracing the use of technology, how it can make things more affordable, how it can make things more accessible to a wider population. And that's going to speed up and enhance the availability of diagnostics to more patients around the world. Now, cancer is a key area. For anyone who's had cancer, had chemotherapy, or loved ones going through that process will know how tough and challenging it is. So it's really wonderful to see the progress that's been made. It's not surprising this is an area that people want to know more about, because we all want to see the progress made. And there's a whole array of companies that are kind of delivering breakthroughs on a almost weekly or monthly basis in terms of progress through trials. One of these areas is antibody drug conjugates, ADCs, which is a much more precision-focused way of delivering chemotherapy. And to help me explain that and get behind the science, there's a short video that kind of just talks through a few aspects of this. Let me play that now. So what are antibody drug conjugates?
The challenge of cancer treatment is doing our best to ensure that the benefits a medicine brings outweigh the burden of unwanted side effects. Take chemotherapy, for example. It's a powerful treatment which kills cancer cells. But in doing so, it doesn't differentiate between cancer cells and healthy ones. So it damages healthy cells too, leading to side effects like hair loss and tiredness. Monoclonal antibodies are also used to treat cancer, and are capable of more targeted attack on tumour cells. But what if we could combine the targeting power of monoclonal antibodies and the toxic properties of chemotherapy, ensuring that chemotherapy selectively kills cancer cells? That's where antibody-drug conjugates, or ADCs, come in. There are three parts to ADCs. First, a monoclonal antibody that targets a specific protein on the surface of cancer cells. Second, a potent chemotherapy drug. And finally, linker molecules that attach the chemotherapy drug securely to the antibody, breaking only when the chemotherapy is inside cancer cells. So, ADCs are designed to specifically seek out cancer cells and deliver their chemotherapy payload directly into these cells, limiting damage to healthy ones. For patients, this potentially means fewer unwanted side effects commonly associated with chemotherapy, but all the cancer-killing power.
So that's what we want to hear, better efficacy and less side effects. And this is obviously great news for patients, but it can also be great for investors as well. We had a company in the portfolio last year that delivered over 600% return, focused specifically on an ADC for ovarian cancer. During the early part of the year, it delivered some very good clinical trial data, progress in terms of getting the drug approved and had it subsequently approved. And that caused the stock to rally probably 200-300%. But after that, the adoption of, or the use of the medicine, the treatment by doctors began to pick up. And that led the companies to deliver better than expected earnings. And actually at the end of the year, a large pharmaceutical company, as happens so often, came in and bought that biotech company and said, we want to take that treatment, we want to globalize it, we want to market it around the world. And that's the opportunity we can find in investing in these companies that can deliver some very good returns. Now obviously we'll talk about later on the other side, the ones that go wrong. But the key is if you can find the right ones, there's some great investment opportunities, and obviously at the same time it's important to avoid the ones that don't do so well and have very good risk management to the overall approach. So moving beyond those treatments, we have a glitch. Can we go to the next slide, please? Why have I got Oprah Winfrey here? Well, we have to talk about obesity, given the GLP-1 drugs are really kind of capturing all the headlines, what everyone likes to talk about when it comes to healthcare, creating a bit of turbulence as well in terms of how people think that these obesity drugs can kind of change the way that the certain disease categories are treated. But without a doubt, obesity is a major, major area. We think this could be one of the biggest addressable markets. And that's because obesity is the cause of so many other illnesses. And Oprah Winfrey is significant because she kind of spent years struggling with her weight and saying how people needed to diet to get fit. But she's come out and said that actually these drugs can make a real difference for people who are struggling to lose weight other ways. And we've already seen some studies that show that these drugs can reduce the likelihood of other diseases, for example, cardiovascular. So some really good data coming out. And specifically, these drugs have been around for many years. They've been used to treat diabetes, but one of the side effects was suppression of appetite. And the industry has worked with that and now has these GLP-1 drugs approved specifically for weight loss, and they're showing that patients are losing 15 to 20% of their weight. But there's still a lot of innovation going on. There's a lot of other companies that are looking to modify these treatments, supplement them with other treatments to improve side effects, to improve the efficiency, improve the type of weight loss that's being achieved. So this is an exciting area. We think it's set up well for the coming decades, and we think we're going to see revenues really growing from this area. Another area that we're excited about is medtech. Again, people with diabetes. You may already have a patch on your arm or an insulin pump on your body that helps you regulate your insulin levels, your blood glucose levels, to ensure that you can live with your condition without having to prick your fingers for a glucose reading or inject yourself with insulin throughout the day. So just like a smartphone has made your life easier, this technology is also helping your disease or your illness management, your condition management as well. So we're seeing some great breakthroughs here. The UK, for example, has just introduced this under the NHS, and we're seeing great potential rollout and increased penetration for the medtech companies. But medtech happens in all sorts of areas. Robotic surgery is another example. So we're really seeing innovation helping throughout the healthcare industry in terms of making things more efficient. And AI and technology is a key part of this. AI isn't going to change how medicine is conducted, but it's going to really change and enhance how scientific professionals, how clinicians are using information. So already artificial intelligence, faster compute, is helping scientists search through vast amounts of data a lot more quickly. Some companies are saying that it will help deliver molecular compounds that will deliver treatments that they can go through clinical trials. We're a bit more dubious about that. It'll take time, but it can help set things up. It can help the scientists in the lab reach conclusions sooner. It will still come out with false information, but it helps speed up the overall process. And we think this is a major game changer. More importantly though, diagnostics. Technology can make things cheaper, more accessible. Liquid biopsies on blood samples, for example, can test up to 50 different cancer types, looking for DNA shed by cancer at a much earlier stage that gets picked up in regular scans. Again, this is still early in its rollout, but we think we're going to see more and more examples of this technology going down the line. So a lot of innovation. We think it's a very exciting sector. We think it offers a lot of different characteristics and go in investors' portfolios. So how do you actually get exposure to it? Now, you can invest in individual stocks in the pharmaceutical sector. These are the large pharma companies, the Eli Lillys, the Novo Nordisks. But even within those, there's a huge spread between the winners and the losers. But it's the biotech companies that have a lot of innovation, a lot of growth. These are typically companies you wouldn't want to invest directly because they're the ones that can go up very quickly, but can also go down very quickly. You really need to understand the science, know how to navigate them, figuring out which ones are well positioned. You've then got the medtech, the tools companies. Again, they've also got a lot of growth within them, but there's also a lot of other aspects within there as well. The COVID tests that we all used, the packaging that goes around drugs and syringes and refilling prescriptions and all of that technology comes in this sector as well. And then we've got the healthcare services, the diagnostic labs when the blood gets sent off to be tested, your health insurance in some cases, also clinics and hospital systems who sit within here. So we've got some characteristics that are very defensive, the ones that are resilient in downturns. We've also got some other characteristics from medtech and biotech that can offer that really strong growth. And that's why we're really excited by biotech and the growth and the innovation that comes from there. So that's something we'll talk about a little bit more later on. And when it comes to Janus Henderson and how we're positioned, we've been investing in specialist healthcare funds for over 25 years now. We've got two kind of core flagship products that are available on the Endowus platform. One is the Janus Henderson Global Life Sciences Fund. That's a fund that invests in all four quadrants that I just talked about. This is a fund that's got a very strong track record since its inception, and over the last 10 years it's outperformed the global equity market. So again, when I say that these funds can outperform over the long term, that's a good example. Over the short term, it has lagged the wider market because people haven't been so focused on healthcare. They've been focused on generative AI and tech. So we think that's why it's a nice opportunity to get into a sector that has lagged. Biotech, on the other hand, has delivered some very strong returns. Our fund's been in existence for 5 years now and has given some strong, nearly 20% annualized returns, outperforming the wider market. It has, however, been a very difficult year for biotech. When we talk about our strategy in more detail, there's a real opportunity to buck the trend of the wider market by basically navigating the inefficiencies between those winners and losers. And that's something I'd like to talk about a little bit later on, I think, with Hugh. So I'll leave it there. As I said, we think this is a very exciting area and look forward to now discussing some of the key attributes and some of the areas that interest you most. I'll invite Hugh up to help me with that process.
So my name's Hugh. I'm the Chief Investment Advisory Officer at Endowus. I look after our investment office. I've been at Endowus for about 1.5 years now. Prior to that, I was a allocator at family office in Singapore for about 4 years. But before that, and I'm some familiar friends here, I was in Hong Kong, and I was a bottom-up hedge fund investor, as well as being in the sell side. And the personal story is that when I was in the hedge fund industry, I wasn't allowed to trade PA. But then once I moved to a family office, I was able to be a little bit more flexible. But there was a time when we were looking at a very interesting biotech fund at a family office. Because of that, I got very bullish on the sector. But I wasn't allowed to, well, I was, but I just didn't have the minimums to buy the fund, which was $5 million. So I said, okay, what's the next best thing? So I decided to buy the XBI US ETF, which is a small to mid, can you hear me? Yeah, small to mid cap biotech sector ETF, which has historically been very strong because of innovation and growth and so on. And as Andrew alluded to, though, it has actually had some struggles over the last 2 years or so because of rising interest rates. But at the time, I was actually lucky because it was a period where it was very, very strong. and I had actually taken profit because I thought it was going a little bit overboard. But then at the time, had I known that I had access to funds like the Janus Henderson Biotech Fund, it would have been very different. And I think it's very difficult actually to find very high quality biotech funds that are available to retail investors. So I'll just start with that. But with that, what I wanted to ask you, Andrew, is how important is stock picking in the biotech? Because like a lot of what we say at Endowus is also that long-term active management is challenging and so on and so forth. So biotech is probably one of the sectors where I think it matters a little bit more to have that domain expertise, right? So maybe can you help our clients understand how that works and why Janus Henderson arguably is better than others?
That's a very, very good question, and I think the simple answer is biotech, and to a certain extent the broader healthcare industry, is the perfect kind of match for active investment management. I've got a slide here which I just want to show you, which basically talks about the disparity of returns between the best and the worst performing stocks. Essentially, healthcare has the widest spread, so you've got some great winners in there and you've got some great losers in there. On the right, you can actually look at biotech and see that the best performing stocks go up on average about 300% a year, and the bottom performing stocks lose about 80% of the year. So clearly, if you've got the ability to pick the winners, you can have a very nice return. You've got the ability to avoid or short even the losers. Again, you can generate some very attractive returns. Pharma is similar, and as you can see, other areas like semiconductors, technology, they also feature relatively highly. But biotech and pharma is kind of the widest area. And that's because healthcare is very binary. Both when you take drugs through the pipeline, we call this the 90-90 rule. Most of you know this because I saw the answer to the poll. But 90% of drugs will fail during their clinical trials, 10% will make it. And this goes everything from phase 1, phase 2, phase 3, and that's different stages of the process in terms of how they do clinical trials, and kind of the progress that they make. We typically invest in the later stages, phase 3 for example, so it's really the kind of make or break before a drug is approved, so the failure rate is reduced. But phase 2 as well, there's some good opportunities. But if you can kind of navigate in there, you can take advantage and get the winners and avoid the losers. And the same things with commercial risk. When a drug is approved, how big is the demand going to be? This is such a diverse and complex industry. Doctors are prescribing all sorts of different drugs all the time. It's not just a simple case of, I want to build a large language model, so I'm going to buy an NVIDIA chip. It's far more complicated, and therefore, we think that you need to understand the industry to a very deep level. So we've got PhDs, we've got a medical doctor on our team, and their focus is really on understanding the science. And that's why a lot of generalist funds will avoid the sector, particularly the biotech sector. I saw a client earlier today, and they were talking about, talking to hedge funds and how many of those generalist managers will avoid the biotech sector because they just don't have the expertise to really understand it. It's much harder than, say, backing a certain industry or another company that's mispriced or something else. Because biotech is really about the science and figuring out whether something's going to work or not. It's binary in nature. So the opportunity really is to be able to kind of navigate that, and that's something that leads to the opportunity that you mentioned, that even when the index is going down, you can actually find some stocks that are doing really well. In our portfolio in 2022, we had 5 companies that delivered over 100% return. And that's because if a company has a breakthrough for a cancer treatment or another treatment, the demand for that will be huge. Also the fact that chances are the valuation is not pricing in success, it's not pricing it in. So as companies de-risk, that's why there's a huge value creation. If you can buy into private companies beforehand, they then IPO, they then have more funding, they then deliver a treatment, that's where the value creation comes from. So if you can get it right, there's huge returns to be made. If you get it wrong, which we do as well, you could lose a lot of money. So that's why risk management is also very important. So when you have a portfolio, you need to be able to manage that risk accordingly and kind of keep position sizes sensible, which is why a diversified fund strategy makes a lot more sense than, say, picking one or two biotech stocks that you read about in the Wall Street Journal or whatever and saying, that's what I'm going to back, because as quickly as they go up, they can go down as well.
So while we're on the subject of biotech, before we go into other sectors though, I just want to delve a little bit deeper on valuations, right? If I look at the sector, again, not going to Janus Henderson per se, but just the sector itself, again, it has a proven history of innovation, growth, and it is arguably a segment that is very, very resilient to recessions and discretionary spending, right? Because if you have cancer, like, you're not going to save on your costs. Having said that, it's gone through for those of you who are interested, go check out the XBI chart. It looks like that into 2021, and then it completely got obliterated over the last few years, and it's coming back now. But obviously, a big part of that is the interest rates, right? It's a long duration sector with a lot of revenues and earnings coming out in the very, very long end. Therefore, it gets very sensitive to valuations, and with rising interest rates, understandably, some of that move is understandable. Now, my question on valuations is, especially given the sector is not a cash flow generating sector, how do investors think about valuations? Like, how do we know it's cheap? Can you enlighten us a little bit there?
So I think maybe just some background first of all. As I said earlier, healthcare has actually underperformed over the past kind of 12, 15 months on the back of being much more resilient than the wider market in 2022. When we talk about those four sectors, they're all very, very different. You can't say they're all driven by the same factors, because a company like Pfizer has been seeing massive revenue declines because they made so much money out of COVID treatments in 2020, 2021. So naturally now we're stopping, reducing the amount of COVID treatments, vaccines, diagnostics. We're seeing those revenues decline. Same for the diagnostics companies, for example, the ones that were doing the COVID tests or providing those patches. They've just seen a reduction. Whereas other companies like the GLP-1 companies that are doing very well on the back of that, they're seeing a real ramp up. Some of the other companies as well. It all depends on the pipeline of drugs they've got. Also, some pharma companies have patents expiring, and that's a challenge for them. That's why they're constantly doing M&A. So pharma is a very diverse sector. It's not one that you can say the industry earnings trend is this, the industry valuation is that, because there is such a wide spread between them. But generally speaking, the pharmaceutical companies, the more healthcare services, tend to have different characteristics, say the medtech or the biotech companies. So the point on interest rates, which is a key one, is biotech has really struggled in the past 2 to 3 years. It did very well during COVID. We saw a lot of IPOs, we saw some sky-high valuations. But in 2021, that started to rupture, if you like. I think some of the investors that got in 2020 were a bit disappointed. We then had the prospect of rising interest rates, and biotech is a sector that requires funding. And when interest rates go higher, it's harder to get funding. Silicon Valley Bank in the US folding last year, again, it reduced the ability for companies to get financing. Life science private equity, we didn't see funds going into that sector, so again, they didn't have the money to kind of spend. So it was a challenging year. But at the same time, so we saw a massive correction in valuation, 63% I think for the first kind of 18 months. It then recovered a bit and then went down. But between 2021 Q2 and October last year, we saw a minus 50% correction for the XBI biotech index. But as I said, that didn't mean you couldn't make money. If companies could deliver a treatment, they were delivering great results. So within that, good data was being rewarded, but mediocre or bad data was being punished. The great thing today is that we're seeing those valuations really corrected. We're starting to see now interest rates headwinds lifting. Sure, we have a debate when interest rates are going to get cut. Is it going to be June? Is it going to be whenever? But the key thing is we're not seeing that steep increase anymore. And there is plenty of funding available for companies that can show the data, show that they are going to progress to the next stage. Sure, investors are discerning, but there are opportunities to raise funding. So we think generally the outlook is looking a lot better now. Valuations are attractive, but to your point, the biotech companies, most of them, well not most of them, but a lot of them, most of them by number, by market cap size, probably about half of them don't generate revenues. And those companies therefore don't screen on a PE metric, price earnings metric. But there are other ways of looking at it. I think in October last year, the low point, we saw a record number of companies trading at negative enterprise value. The market wasn't giving them the credit for the amount of cash on their balance sheet, let alone the pipeline of drugs. We've got some great stocks in the portfolio that we were able to buy, that we basically said the market's currently pricing it based on one drug that's doing well, but this is their pipeline that's coming through, and we're really excited about the future revenues that could come from this. So that meant that we could pick up a lot of very interesting companies attractively.
Just to follow up on that, would one barometer be for pharma companies to be buying biotech companies as an M&A target? Are you seeing any of that?
Yes, so I think that's a really good example. M&A, as I said earlier, is kind of the lifeblood of the pharmaceutical industry. They need to do acquisitions to continue to fill their pipeline of new drugs, to replace their patent expiries, to get the new innovation. I used to think that pharma companies used to do all their own research and development, but no, they just buy in all these other companies. And that's why these biotech companies aren't going to become the next Googles or Amazons, because they get acquired and they get absorbed into a Pfizer or into a AstraZeneca or someone else. So we saw a drop-off in M&A in 2021, 2022, initially because valuations got very high, and public markets were willing to pay a lot, so I think there was a bit of caution. 2022 was also a challenging period with interest rates going up, but last year we saw a real pickup. I think we had over 22 deals over $1 billion, particularly towards the end of the year, and one of the reasons was valuations were attractive. Because remember, it costs $1-2 billion to take a drug through the trial process. So if a large pharmaceutical company can come in and buy it for $4 billion, they're quite happy to do that, because they're basically buying something that's been approved or nearly been approved, doing it without any of the headache of drug failures and all of that. So it's efficient use of their capital. And we estimate that the largest pharma companies have close on $1 billion of firepower, $1 trillion of firepower to do these acquisitions, both in terms of equity and debt, because the large pharma companies throw off cash. So that's definitely a barometer. Q1's been a bit quieter, but there was a bit of a surge in Q4. We certainly expect the M&A to continue to be active. We had one company in the portfolio acquired a month or so ago. Last year, I think we had 10 in total. So we're seeing some good activity on the M&A front.
Great. So I'll probably have another few questions, and I'll give it to the floor. But just moving away from biotech a little bit, you're explaining that there are four kind of distinct subsectors within healthcare. One is the big pharmas, medtech, services, and biotech. And the two funds that are in the Endowus platform, the life sciences, cover everything. Biotech covers biotech. So for our investors, how should you think about the allocation, if you must? And maybe if you can tell the investors a little bit about, I think we talked about biotech, but for the other three, what are some of the more interesting aspects that we can think about that drive the growth within those subsectors as well?
Sure. So I think in terms of our global life sciences strategy, that's the point I meant to raise earlier. But as I said, we're investing in the four areas. And the nice thing about this sector and the strategy is this kind of barbell of offense, growth, and defense. So as I said, biotech and some of the medtech is very growthy. It can be volatile, but the volatility is more linked to its own idiosyncratic events. And then you've got pharma and kind of healthcare services, which are typically much more stable and can provide that defensive ballast to a portfolio. So I like to liken our global life sciences as that kind of core barbell of defense and growth. I take the view that over the long term, it should give global equities a good run for its money. So, allocating to healthcare as a specific subsector of your overall global equity exposure makes a lot of sense. Plus, it gives you the reassurance that if, so that we didn't show the slide up here, but over the last 5 downturns, for example, healthcare has underperformed or basically fallen by less than half the decline of the wider equity market. So if we do have a horrible correction, like the financial crisis or even the COVID kind of sell-off going into COVID, if history repeats itself and pharma and healthcare is defensive, you should see a much less decline from healthcare as the wider market. Now, there's no guarantees, but that's kind of where we think it's set up, is what the last 5 downturns have showed us in the last 25 years. So we think if you are cautious about equity valuations at the moment, this is a nice way to kind of go into the market and offer something for your portfolio. The biotech strategy, you have to have a more resilient view on volatility. We think now is a great time to be investing. We think things have been tough. The index, as we heard, fell 50 or 60% in an 18-month period a couple of years ago. So you need to be aware of that. We think we're able to mitigate some of that through stock selection, but those stocks we invest in do move, they are volatile. So you need to look at it from a long-term growth perspective. Despite the wider market correction, we've delivered 20+%, nearly 20% annualized alpha versus the wider market over the past 3 years versus that index. So actually, if you held our fund over that period, you would have had a positive return versus the big loss from the index, but that's obviously past performance. But we think there is that greater growth opportunity coming from biotech alone because you're not encumbered by the more defensive characteristics, the more boring characteristics, if you like, of steady income and stable balance sheets. But for a balanced portfolio, the broader strategy makes a lot of sense as well.
Yeah. So last 2 questions. One is on innovation, and I think it's related to what's happening in the tech sector as well. I mean, obviously AI is one of the most buzzwords in the market, and it's driving performance. And like you were alluding to, other sectors outside of large cap tech have underperformed because of that concentration of a few names. So how do investors think about innovation within the context of the healthcare sector so that they don't feel left out? And does AI actually have a spillover effect so that you can actually benefit from AI trends by investing in healthcare or biotech?
I think first of all, why has technology been a long-term outperformer? It's outperformed markets over nearly all time periods, even looking at the dot-com crash. If you invested Microsoft at the peak, you've still made money 25 years ago. It's because it's full of innovation, it's full of growth. It changes the way things are done, and that's why technology takes greater share of the global economy. If you think about biotech and healthcare and the treatments, the diagnostics that we get, it's just changing the way things are done. It's doing things better, more effectively, and it's something we're willing to pay for. So that innovation is very important. It's disrupting other things. So that innovation, I think, is what's generating the growth, and that kind of ties in nicely with the aging demographic, the fact that we want more healthcare. We've also got to be very careful of innovation because we've got many companies that get innovated or disrupted by innovation in other sectors. You can have a great pneumonia vaccine, but when someone else produces a pneumonia vaccine that has more strains, all of a sudden doctors stop writing the prescription for that one and start writing the prescription for the other. So the opportunity is finding the innovative ones that are going to take share and basically benefit on the back of that through the growth in revenues and therefore the valuations that they get. So the innovation is what we want, and we think it's a major theme across all sectors, all you're investing. You want to be in the innovators, you want to be in the quality companies, you want to avoid the ones that get disruptive or the ones that don't really have a clear angle. So healthcare, we think, is just great for that because it's really set up with that innovation kind of front and centre.
Last question is on China, which is, I think there's a few people in the room, and I'm sure your understanding of the sector. I mean, China biotech, healthcare, etc., has been a darling in the past. Recently has gone through some trouble. How does Janus Henderson think about biotech and healthcare outside of the US and particularly in China?
So there's obviously great innovation going on in China, just as there is everywhere in the world. So it's, great scientists are not tied to any specific market. Our focus is on the US. It's where our team are based. It's where we have plenty of opportunities. We're not short of opportunities. We have been happy investors in Chinese companies. China is a huge market. We've got several in the portfolio that we think have got very attractive valuations versus the potential market size. We're excited by that long term. Yes, the volatility and kind of the overall sentiment to the Chinese market has been a bit of a headwind to some of the share price performance. But we're long-term investors and we look through that. So I think we look at all markets around the world, whether it's Japan, Australia, China, Europe, and the US, and we're looking for opportunities across the board. Because at the end of the day, we're looking for the drugs that will change the practice of medicine, make things more efficient, address unmet medical needs, and we know that the population of people is everywhere in the world. So if we can find the companies that are targeting that, that's what we look for. So whilst we do have a focus on the US, it's where the index is more focused, it's where frankly there's the biggest abundance of opportunities at the moment. We're happy to look everywhere for the right opportunities, as long as we get comfortable with the overall prospects for returns.
Okay, with that, I'll hand it over to the floor for questions.
Thank you very much for the sharing. I actually going to ask the China question, but you've answered already. But I want to ask about the US, because it's well known that it's the most expensive healthcare in the world. And a lot of like FH people that talk about lacking insurance, where insurance premium keeps increasing. Of course, your premises that is defensive, it relies on the US system probably remaining as is. Is it sustainable? And of course, China, the problem is when you have innovative drug and then the government, you have a group bargaining. That's another very totally different system. I'm really curious on how sustainable is the US healthcare system in itself. Thank you.
That's a debate that's been kind of long running in terms of why drugs are more expensive in the US. But another point is there's so much innovation from the US, because that's the opportunity. Drug companies can see the market size in order to deliver. They've got a very strong insurance network. But it's true from a wealth divide perspective, the haves and the have-nots, and so having better access for more people is kind of key for society. And that's why it's very interesting that in the last election, Biden was very focused on the Inflation Reduction Act, saying that he thought Big Pharma should come to the table and negotiate, and he started to do that. But interestingly, the drugs that are being selected are ones that have been around for a number of years. They tend to be towards the end of their patents. And the key message is clear. We don't want to have drugs that were great innovation 10 years ago still charging sky-high prices. After 10 years, they've recovered their R&D costs. These prices should be lower, and we should have new innovation. But what they don't want to do is stifle innovation and basically say, if a biotech company has a great drug, they're not going to be able to recoup their $2 billion of R&D. So the pricing model that has been progressed now seems very sensible. And it's encouraging innovation. We hear people worried about patents, but at the end of the day, if you're still relying on the same drug in 10 years' time with the current pace of innovation, what's gone wrong? Why has no one else developed something to come through? So it is about kind of constantly refilling the pipeline, which is why the leaders in cancer treatments, the leaders in obesity drugs, are always looking for new opportunities, doing acquisitions, doing their own R&D to kind of progress that. So I think the other part about affordability, the Inflation Reduction Act also reduced co-pays in the US, because unfortunately a lot of people who have a disease and they have treatment, they can't afford to have the treatment, even though the insurance company will pay some of it, because they can't afford their co-pay. So lowering the co-pay actually opens up the accessibility to more people of the treatment. And obviously the insurance company have to pay for this, that creates a healthcare cost, and indeed, I'm from the UK and the NHS system is kind of creaking. But it's all countries are facing the same kind of structural dynamics. But at the end of the day, innovation, I think, is key. If we can make cancer treatment cheaper, if we can provide drugs to a broader array of people, that's the opportunity as well to kind of help those issues. That's why the NHS, for example, in the UK is investing in AI, is investing in other treatments as well that use this technology, because they see how that can help ease the pressure in the system.
I have two questions. I always find it very challenging when looking at investing into healthcare funds, because it's a hugely technical sector. Secondly, as you mentioned, it's binary, therefore it was low risks. So my question is that what's the best way to look at the investment professionals that are managing this fund? Because I look at a few funds that normally is a mixture of doctors and finance people. So I want to know in your view, what's the best mix? And my second question is, you also mentioned a lot of M&A activities, but then what's the best way to invest in that? Is that through a public fund, through listed companies, or is that through the private market?
Let's start with the M&A question. we don't believe in event-driven investing for this strategy. We're not buying companies because they're going to get taken over, because we want to buy good companies that are going to change the way things are done and generate revenues. And typically, they're the companies that large pharma companies want to acquire, because they're the ones that are doing the right thing, delivering the right treatment. So, in a way, if you can pick the good companies, the M&A will come to you. So we wouldn't invest in a company just because it's going to get taken over, because you often see companies that maybe failed or are struggling, they get taken over because they may have an asset in there that's interesting, but you're not going to get the large takeover premiums that you get elsewhere. And if the company doesn't get taken over, well, you're in something that's a bit of a value trap. So we don't invest from an M&A point of view, but we expect M&A to very much drive returns, because it's doing the same thing we are doing. Because it's not private equity buying these companies, it's pharma companies buying these to refill their pipeline. That's very different from when we look at private equity investing and doing leverage buyouts and all sorts of other things. This is about product development and building out the pipeline. So we think investing for M&A is about finding the good companies, and the M&A will come to you. The first part of your question about how you navigate it and figure out, I guess, which managers, which funds are good, because there are a bunch of funds out there, and there's some very good funds, and we've got lots of peers who are exceptional at what they do. I think one of our differentiators is how we kind of look at both sides, the science side, and there are other funds that are very much event-driven, and they're saying we're buying into this company because they've got a drug going into phase 3 trials, we think it's going to work. Boom, it worked, let's sell out and find the next opportunity. So they're a bit more short-term driven, whereas we are very long-term driven. If we invest in a pre-IPO, a company before IPO, we'll typically hold it through the IPO, we'll add to it. As it gets through phase 3 trials, we may still add to it, even though the share price is going up, because we see the greater prize. And that greater prize is the commercial side of things. How big is the market penetration going to be? Why was that company I mentioned earlier, ADC, acquired by a large pharma company? Because they thought the revenue in the market was much larger than the market was anticipating. And so as those sales come in, we were holding the stock because we thought as the company goes through the next few quarters, it'll surprise the market with better sales. And that's again where M&A came in, because they kind of saw that wider opportunity as well. So looking at both the commercial side and the clinical side is key in our view. And there's basically two sides, two parts to the inefficiency that we look to navigate. How does the team do it? You've got to understand the science. We've got our team spend a lot of time at industry conferences in terms of the actual medical industry conferences where doctors are unveiling new drugs, talking about research. So our pharma analyst was in Chicago when they unveiled the Novo Nordisk's Select study, and kind of relaying that information in real time, conversations she was having with doctors and things. Again, there are a lot of our industry peers there as well, but we think that's the sort of opportunity to be looking at the science, looking at the research journals, thinking about what's coming down the pike is more important than just sitting at your desk and waiting for a broker note to come in and say, buy this stock, at which point it's probably a bit late.
Can I just add to that? I mean, the thing that I find interesting about the Janus Henderson Biotech Fund is actually on the risk management side. In terms of the way, I think they have a max drawdown risk limit of 200 basis points, meaning that if you have a very large size 400 basis points kind of position, let's say the max downside is 50%, that's your 200 basis points. So to make sure it doesn't go over that limit. And I think there's a lot of other funds out there that have medical doctors and experts and scientists and so on who also argue that they know it really well. But I think the portfolio management and risk management side is also equally important in terms of delivering good risk-adjusted returns.
Yeah, that's a great point. And actually for our Global Life Sciences Fund, we have a 1% drawdown. For the biotech, we have a 2%. And that means that we love a company. We think it's the next best thing. But if it fails that trial, it's going down 80%. We're not going to put more than, for a biotech strategy, more than 2% into that company. Typically we'll have 100 basis point positions, 50 basis point positions. So if you look at our fund, you'll say, you've got 100 plus names. How have you got conviction? This fund's only got 50 names. Well, actually, we have conviction in those 100 names. We're not hugging the benchmark just because that's what we do, but we want to basically de-risk and have a good array of risk across all these names, because when we get it wrong, because we don't get it right 100% of the time, we don't impair the value of the overall fund. So we're very nervous when we see some funds that got in their top 10 holdings some crazy biotech companies that most people have never heard of, because chances are they've done really well and delivered a good return, but if they reverse, then you've got a problem. So our approach and our philosophy is about harvesting an alpha consistently in small chunks along the way. And then the ultimate way for you as an investor to look at that is to say, okay, show me the track record. How has the fund performed in a good market? How's the fund performed in a bad market? And if you look at our Horizon Biotech Fund versus the indices, you can see the deviation versus that.
I also add on liquidity, because normally biotech is a small to mid cap sector. There is a asymmetrical risk reward when things go well versus bad. So when things go well, obviously the clinical trial work, the liquidity explodes. When things go poorly, you can't sell your position if it's very big, right? So that position management, risk management is very, very big, important as well. Yes, on the back.
Hello. Thank you, Andrew, for your sharing. I have two questions related to China. The first one is WuXi Bao is a leading Chinese CDMO, and the stock price have been doing pretty bad, but they are very good with ADC. What's your view on WuXi short term and long term? That's my first question. The second question is, there's a lot of pre-revenue Chinese company seeking to licensing deals with other Western big pharmaceutical company. How do you, as an investor, how do you navigate and identify the most promising candidate that has the highest probability to do the licensing deals with other big pharma?
So I'm going to answer that a bit more generally, but with ADCs, some great successes coming through, but it's actually very, very difficult to get it right and to get the right molecules in the right dose in the right patients to get things approved. So the ones that succeed, the success stories, there's many that don't succeed and don't get it right. That's the 1990 rule I talk about, and it's true in ADCs, it's true across all sorts of areas. So, we look at each company kind of individually, we kind of assess it, we understand it. We're not going to get all the winners, we're not going to avoid all the losers. So, I'm not familiar with that name myself, so I don't want to comment on it specifically. But, I think the thing about biotech investing in particular is that there is such an array of companies, particularly to Hugh's point, small and mid-cap companies. And so, we're kind of spoiled for choice in terms of kind of what we invest in, but you really need to kind of get to understand what you're investing in and where your conviction is, and have that risk management. So that's something we'll do. Your second part of the question in terms of just kind of licensing, again, I think that's an interesting area. We do see companies that do the licensing agreement. Both in the public markets and private companies that have those agreements. I think it's a way that you can get drugs that are working in one market into another market that's got very large populations and addressable patient audience. I think again, trying to pick the winners and losers really comes down to the minutiae of the investment process in terms of understanding the specific offering of the company that's doing it, how they're set up. Also the drug itself, in terms of all of that, in terms of think about the supply chain, the demand backdrop, what other drugs are in there. So they're all things that go into the kind of the mix and into the pot, which we do for every company we invest in, wherever they are in the world. So that'll be no different. Unfortunately, there's so many companies out there, and we're never going to cover all of them. But I think again, that's one of the nice things about this sector, because it is idiosyncratic. You don't have to be the biggest to succeed. A lot of the smallest companies will come up and surprise you and give you some great opportunities, and that's what we're always scouting out for.
Thank you so much for sharing. My understanding is you guys do public and private investment, both. So for private investment, especially for China, biotech companies or medical devices or pharmaceutical drug discovery, do you have any specific concerns investing in Chinese companies given the geopolitical risk and all things considered?
So yes, when it comes to private investing, we have up to 3% of our fund that can invest in pre-IPO companies. So they're typically companies that are about to IPO. We're not majority shareholders, we're not kind of early stage backers. We're investing in companies that we think are going to IPO in the next kind of 12 months or so. And we typically do it with a consortium of other investors. We may be one of the larger investors, but we do it kind of through a fairly tried and tested formula that we've done for the past 20 years. So we've been investing in private companies since 2004. And so for us, it's about looking at the company and saying, would this company work in the public markets? When it comes to different geographies, understanding the different regulations is key. I think with any company, we look at all the different attributes from your balance sheet, product, management, all of those factors, and that kind of helps our decision. So there isn't one kind of macro view that we say we won't do this or we will do that, because we have to look at it on a stock-specific basis and look at each company for its relative merits. And we're fortunate at Janus Henderson because we've got a very large global team investing across all markets, including China, and our healthcare team leverage those insights as well.
What about like gene therapy, data related?
So
I'm just curious about, is there any sensitivity in terms of investing in US dollar, US LP, US fund, that's from Chinese biotech companies that are related to those areas, that very sensitive areas? I'm just curious.
Yeah. I think it's there's a whole range of discussion points here, and I think it always just boils down to the fact that we need to understand what we're investing in, where the returns are going to come from, what we're confident in. We are at the end of the day looking for drugs, medicines that are going to work and going to deliver returns. You do have to be very aware of all sorts of other aspects. We've had data breaches in the US, for example, in companies. Unfortunately, that's the nature of investing everywhere at the moment. More information on the cloud and all of that. So it's something that companies and management teams need to be very aware of. So we have to understand how management teams do things.
Thank you, Andrew. I have a follow-up question on the funds. What is your view of where we are in the cycle? Are we seeing an upcycle for certain subsegment of the life science and biotech and versus the other sectors that you identified?
So biotech, we think we've kind of been through that very difficult period. But the one message I want to leave is that biotech is not really a sector that goes through cycles. Yes, we've had this headwind of interest rates, but actually, the demand of the industry is not consumer-led. It's kind of led by the demand of, unfortunately, sick people and patient needs. So the opportunity is to find treatments that work, and those are the companies that can do well. And that can happen in a bull market, it can happen in a recession. So it's about picking the right stocks, which is why we've been able to find stocks that do really well in a year that the market does really badly. So that's kind of more the biotech's idiosyncratic, it's finding those opportunities. Pharmaceuticals, there's companies that have been having some horrible negative earnings because of COVID runoff or because of patents running off. So there's stock-specific examples you want to avoid, whereas others that you like because you see a growth profile. So generally from a sector perspective, I think where we are today is very different to where we were a year ago. January last year, where we are, May, April, a year ago, we were still nervous about the global economy, we were still worried about recession, we weren't quite sure what was going to happen. So people were actually quite overweight, from a generalist fund manager point of view, the healthcare sectors, because they'd done well in 2022. A lot of fund managers were avoiding technology a year ago. That was obviously the wrong place to be, but we've seen a rotation out of healthcare into those other sectors over the past year, and we think that's kind of run its course now, just as the runoff from COVID kind of boom years was a drag last year. We think that's now largely run off. So we think where we are today is actually quite comfortable, that valuations are attractive. Valuations for healthcare relative to its own history, relative to the wider market, is at a discount. There are some things in there that you need to be aware of, like Eli Lilly and Novo Nordisk on much higher valuations skewing the overall data, which is why we don't look at kind of sector trends as much. Our team really are bottom-up stock pickers, and that's what they're looking for. But in medtech and tools, for example, actually in all areas, it's been very interesting, these GLP-1 obesity drugs, because you see headlines about no more obese people, therefore Coca-Cola is going to have less sales, or Walmart's going to have less sales, McDonald's is going to have less sales. But in the healthcare industry, it's the same. People won't need knee replacements, people won't have kidney disease or liver disease. And yes, in theory, in 20, 30 years' time, less obese people, we may have less people with diabetes, we may have less people with these other conditions, so that's what the data's showing. But people still have lots of illnesses, lots of diseases that need treating. So whilst diabetes-led liver disease may be reduced, we've still got other people with forms of liver disease which need treatments. Think of statins for heart disease. People still have other cardiovascular medicines and surgeries, even if they're taking statins, because it helps their survival rates, it helps their living with their conditions, but it doesn't mean that they won't need anything else. So that's why we've been quite vocal in saying there's a lot of exciting areas that are on really good sale at the moment because they've been left behind. So people will still need dialysis, even though there'll be less kind of obesity-led diabetes potentially in the future. So it doesn't mean that dialysis companies are going to suddenly disappear. We did say that there are examples of things that may disappear. Bariatric surgery, people who are overweight, to lose that amount of weight that these GLP-1 drugs are doing, previously had to do surgery. So again, maybe that's an area, those sorts of procedures may drop off, and probably drop off quite sharply, because people see the opportunity now to at least try this new form of treatment. So really, from a sector overall perspective, we think we're kind of in the point in the cycle where if the US has a soft landing, the innovation coming through will still be pretty good. If the US has a harder landing, actually we like the fact that healthcare is pretty defensive. So from a sector-specific point of view, we're pretty sanguine now in terms of the overall environment, and think we're in a good position. One of the great things is, unlike 2020 when money was pouring in and valuations were sky high, that's not the case today. So we think valuations are attractive, and again, it's about us picking the winning stocks.
So I think we're kind of up to time now, but I'll just leave you with one last question, since you said you opened an account with Endowus. What are you going to do with that? Like, what are you going to buy? Which fund?
Well, I've already got the biotech fund in my UK account. I will be buying some more of that. Probably buying some more of our active technology fund. I think that we see the quality trend going. We're very excited about the opportunity for active management. We would say that, but this is a market where stock correlations are breaking down. Factor-based models are going to be less effective going forward. It's more about picking individual stocks, and I think Janus Henderson, we've got a great team of people that really kind of wait for moments like this where stock picking gets rewarded. It's very evident in biotech, but it's also very evident in global equities and US equities, European equities, and also small caps. That's an interesting area at the moment as well, given the de-rating we've seen with the wider market.
Yeah, great. I know Sinting mentioned in the beginning, but one of the reasons why people at Endowus, we created this platform is because we want to create a platform where we can invest our own money. And I think I don't know how much experience you all have in investing in funds, but we definitely have the clean share class and the cheapest way to access these funds. And like I said before, I think the fact that you have access to high quality funds at a very reasonable rate, at a very easy way to access it is actually something that is not as readily available in the past. So I encourage you to kind of sign up if you haven't, take a look at Janus Henderson funds. And I want to thank Andrew for spending your time today. Thank you very much.
And thank you for all the questions and coming this evening. Appreciate coming out.